Talking about MAGI, modified adjusted gross income, and Kristin and I were talking during the break. I guess I'm not exactly saying that the way that you would normally say that if you were a true CPA, right? It's
I don't know if there's a right way. So I've always referred to it as MAGI, or the long word modified adjusted gross income.
Okay, well, MAGI just sounds a little bit more entertaining.
I like MAGI a little better.
Yeah, there you go. Whether it's right or wrong, the reality is that it has an impact on your taxes in ways that really are invisible to the millions of Americans that get impacted by this. I mean, this is one of those things, when you think about it, this notion of a modified adjusted gross income appears nowhere on the tax return. Mm-hmm. But it's lurking in the dark recesses of the calculation that determines how much tax you in fact pay.
Right. It's almost like a mystical calculation because it's different for everything that you're looking at. It's different for IRA contributions. It's different for your premium tax credit. It's different for Social Security. It's just different for everything. So it's almost like a mystical calculation in there.
And it's interesting. And depending upon which thing, we'll give some specific examples here later in the segment. But depending upon what you're talking about, yeah, there's this thing that needs to get added in. There's the other thing that needs to get added in. It ultimately, at its core, right, it is altering the definition of income for tax purposes, right?
Right. So it starts at your AGI, which is your adjusted gross income, and that is on the tax return. It is line 11 on the 1040. Everybody has it, so you start there, and then you add certain things to it, or you can even subtract certain things from it.
And it certainly affects well over a dozen different tax rates used by millions of people. So when you start with that notion of adjusted gross income that's on line 11 of the 1040, what happens next? Like what's the reality of why this exists in the first place?
Yeah, it's really to limit certain deductions for a lot of taxpayers. It's by limiting those deductions, it's more tax revenue for the people up in Washington.
Right. So in other words, a good way. The reason they mess around with this MAGI thing is that they can then reduce the tax savings or the tax benefits that come with certain deductions, and ultimately raise more tax revenue without having to say, "Oh, I raised taxes." Well, no, I didn't really raise taxes. I just kind of changed some definitions, which still resulted in increase in taxes. But anyway, so how do we figure out this modified adjusted gross income anyway?
Yep, so you start at your AGI, or your adjusted gross income, which is usually just your wages, your self-employment income, interest, dividends, capital gains, really all of your income summed up into that one AGI number. And then from there, you can take, usually you have to add back certain income items. So the most prevalent one that comes up is the tax-free income. So municipal bond interest is usually the first thing that gets added back. Sometimes other deductions, such as your student loan interest, will get added back.
Okay.
And then once you get that final number, depending on what the calculation actually is, that is your MAGI, or your modified adjusted gross income.
Well, it's so invisible, and this is where, the role of technology, the use of software really comes into play, because what you're talking about is, well, for certain calculations, I might add back in my tax-free muni income. For other calculations, I may add back in my student loan deduction. I mean, I mean, the amount of effort that it takes to calculate it, I guess, almost forces you to use a computer program.
And the most complicated one is actually the Social Security calculation. That is like a 10-step process. To do it by hand would probably take about an hour.
That is probably the one that we run into most of all, is that modified adjusted gross income as it relates to the taxation of your Social Security. Now, yes, to your point, there's schedules that obviously then exist that you can go and you can hand write out and hand calculate. But yeah, that in essence is where we see a lot of errors on individual tax returns that people prepare. As it all goes back to kind of how this calculation plays out.
Right, and a lot of times when we see them done by hand like that, usually the taxpayer ends up paying more than they're supposed to because they did the calculation wrong. So.
Yeah, in essence, the software industry in cahoots with the lawmakers in Washington, pretty good combination. Make sure you're using some kind of a software to be able to do that. So let's get into some of the specific examples that we've been talking a little bit about here. One of them, of course, is the ability to deduct your IRA. This is one that has a MAGI related calculation going on in the background.
So this one has an income limitation on it, and then it does have that MAGI limitation of you have to add back in your student loan interest deduction.
So if I'm looking at my tax return and trying to determine my eligibility to do an IRA deduction, then that modified adjusted gross income number that applies to determine that requires me to add back in the student loan interest.
Yeah.
So you got to remember that, because otherwise then that deduction winds up being limited. The next one is one that you mentioned earlier. Boy, this is one that really, every time we talk to people about it, it just kind of gets people wound up. What's this next one?
The Social Security and calculating that one. So it's one of the oldest uses of MAGI. So it's never been indexed for inflation, which is pretty incredible, because it's something like $25,000. If you're over that in your income, then it's taxable.
Right. And it's been around for at least 40 odd years, to your point, one of the oldest ones, and never indexed for inflation. So now more and more Americans find themselves picked up by that. Hey, great. Over the past 3 years has been roughly a 20% or so increase with the COLAs on Social Security, but that just means more folks are getting kind of picked up in this taxation of Social Security.
Yeah, and then this is one that requires your municipal bond interest or tax-free interest to be added back into the calculation. Which is unfortunate, because it's your tax-free income is now causing your Social Security to become more taxable.
Well, and this one really is a pretty convoluted calculation, because it's at zero, right? And it's not included, not taxable in Social Security. It's below certain levels, and then there's a sort of a phase or window of income where it's 50%, and then another level where it's 85%.
Right.
So that's not exactly something that you want to do by hand on it. And then I guess another one. These are ones that come up in the office on a regular basis that just people don't like. And so the other one on our list of examples is which one?
It's the IRMA, or the Medicare costs that come with your Social Security. It's income-based, so depending on what your income is for the year, your IRMA or your Medicare costs may go up.
Well, and this one, again, adds back in that tax-free muni bond income, and ultimately, this one can really bite, because if you're $1 over, I think there's 5 or maybe 6 different sort of income levels where the cost of your Medicare keeps going up. In some cases, if you're $1 over, not only you, but then it also applies to your spouse, you could easily be paying an extra $200 per month on your Medicare just by tripping $1 over the modified adjusted gross income limits.
Yep, and that'll last for the whole year until you file your next tax return and your income changes on that.
So pretty significant, real issue that people need to be aware of, particularly as they're working through their taxes. So what should the advice be, Kristin, for taxpayers to sort of deal with this? Because it's always out there, it's always lurking.
Just kind of understand that it's there, it exists.
1 minute.
And it kind of starts at that AGI, or adjusted gross income number, but there are some things that go into it besides that. So just know that it exists, know that there's a calculation, and use some tax software to calculate it.
Boy, I'll tell you, if you're trying to do it by hand, I don't know how you're going to ever do it. You've really got to use that tax software. And then lastly, you can certainly look for ways. There are certainly some ways to try and lower the reported income that makes up that adjusted gross income number. So what are some examples that folks can use to help limit this?
Yeah, so if you're working, you can do pre-tax contributions to your 401k. If you're self-employed, you can do self-employed retirement plan contributions. You can do HSA contributions. That will also lower your modified adjusted gross income. And if you're retired, you can do qualified charitable distributions.
Oh,
That
that's a
would
great one, too.
Also help lower the
Yeah,
MAGA.
we love that qualified charitable distribution. Such a great way to use those RMDs to your benefit, have that not be taxable. So it also helps with the MAGI problem as well.
Right.
So that's cool. Well, good stuff indeed. Well, we're going to take a break here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. When we return, we're going to talk about some of the strategies to beat the survivor trap. Coming up next here on Dollars and Cents with Joel Garris and Kristin Costello of Nelson Financial Planning.